in a guest host for the entire hour. There's no better person for that than Chamath Palihapitiya, founder and CEO of Social Capital. He's also the chairman of Virgin Galactic and co-owner, of course, of the NBA's Golden State Warriors. And recently, he's been very active in the realm of SPACs, special purpose acquisition companies.
And what I wanted to do was take an opportunity to give the viewers a sort of behind-the-scenes look at how we decided to do this investment. It's more than $1 billion. It includes ourselves, as well as a bunch of very well-known other co-investors. And so I think it's important, first, I wanted to just take a step back for you and talk about what this whole craze around SPACs, but specifically what my goals were with IPO 2.0.
When I thought about SPACs, because the audience here is primarily, investors like VCs, angel operators, folks in hedge funds, and then a lot of LPs from family offices, endowments, and foundations, there was a high level of interest in talking about SPACs, and I couldn't think of anyone better. So thank you so much for making the time.
I'm excited to do it.
I think the place to start off here is what are some of the legal and structural underpinnings of SPACs? And then why are they, they've been around for a while. I remember hearing about them when I was in college. Why did they all of a sudden explode?
Well, I think the answer is that sometimes you need somebody to take a fresh look with fresh eyes and think from first principles. I don't think we really do that enough in general in most things. The reason I started to focus on it was in 2016 and 17, the thing that bothered me was how the average time to liquidity was changing in my own portfolio. I had put, at that point, almost $2 billion in the ground. Half of it was mine. And just practically speaking, I was like, I can't keep doing this. I don't have any more money to keep allocating this way, because I thought after 7 or 8 years, you'd start to return capital, and then, you can reinvest that. And so I never thought I would find myself in that situation of being, in a liquidity crunch, basically. And so I was really curious, why are we waiting so long? And, a lot of it was the anecdotal stupidity around Facebook. And even then, Zuck had kind of already said, hey, that was a huge mistake, and I should have gone public a year earlier. And, if you remember the reason why we didn't go public, one of the big reasons why I quit in 2011 was, my effort to build a mobile phone. And in 2011, I think had Facebook gone public and had raised the capital, we could have invested $1 billion. And it probably would have had, I think, a decent chance of being a third rail, a third leg of the stool to compete with iOS and Android. So, I think that a lot of people thought, oh, well, Facebook says stay private longer, so I'm going to do it. All these VCs jumped on it. They said it. So then entrepreneurs just didn't think about it. And then you found all these companies getting overly diluted, overly capitalized. Employees were getting frustrated. They were, as a result, leaving and building a portfolio of options because they didn't see a path to staying at a company, because they didn't want to stay for 15 years. They wanted to stay for 4 to 6 years. So I talked to a bunch of entrepreneurs, and understanding those things, I kind of went around looking for a mechanism to change some of the biggest features and problems here. And we found the SPAC. And, I wanted to find a company for the first one that really validated the use case and really proved product market fit. And so maybe this is a good way to answer the first part of your question. So what is a SPAC versus a traditional IPO? Look, a traditional IPO, I think, is a very good mechanism to go public. It's that it only works, I think, for companies who fundamentally can be judged on the past. So if you imagine yourself as a private equity business, or, a high margin cash flow generative business, the future, as well as the past, as well as today, yesterday, today, and tomorrow, are roughly all equivalent. And when you're like that, the past is a very good way of describing the future. And in an S1 process through a normal IPO, that's the only thing you're allowed to do. You can only talk about the past. You are explicitly, legally not allowed to forecast the future and talk about the future. And when you work with a bank, what they are underwriting, essentially what they are ensuring, is that the things that you said in the past are true. So it does have value. but it has value in markets and in sectors of the economy that are frankly not that dynamic and that are highly predictable. In tech, I would say that tomorrow has nothing to do with the past. And you see entrepreneurs changing and pivoting and trying different things all the time. And in many ways, what you want to really understand, much like you do when you make an early stage investment, is what is the entrepreneur's mindset? How are they thinking about the future? How do they think the market will evolve? How will they adapt and change? And because the SPAC is a merger of companies, you're all of a sudden allowed to talk about the future cash flows, future product strategy. And in that, what you give is a lot more transparency around the process. And when you do that, you have a better chance of being more fully valued. You have a better chance for a founder of having more control, not less. We'll get to that in a second. And you get a bunch of very good features. So that's, I think, why the SPAC worked. I picked Virgin because it validated a lot of these things. You know, Virgin has been building rockets and hybrid rockets. And so the entire valuation is all about the future. So you can imagine in a traditional IPO how hamstrung we would have been in telling the story. But through a SPAC, you can focus entirely on the future. You can provide a very detailed cash flow forecast. You can provide a detailed model. You can provide all kinds of discussion and thoughtful exchange between you and the buy side. And it's made all the difference in that company. Same with Open Door, same with Clover. And I think that, what I'm focused now is just identifying really high growth, disruptive businesses that are entirely focused on the future and whose best days are ahead of them, and helping tell that story.
I think you've been peering over my notes, because one of the questions I was going to run into here is, if we look back now on the ones you've done with Virgin and sort of space and telecom, Open Door and real estate and Clover, it seems like you're sort of backing into a portfolio almost like a VC would. Can you walk us through your thinking on that and how you're trying to build that?
I'm managing my own money at this point. So, I put $2 billion in the ground. That did really well. In 2017 and 18, I went through a lot of changes, both personal and professional, where I completely reset. I had a couple of, really shitty partners, to be honest with you, low integrity people, that combination of quit and fired them. And I returned all the outside money. And so my focus went back to, how do I get back to doing what I like, which is working on really disruptive technologies and companies that I think can have a really important impact in areas that I care about. Not necessarily that that's completely important for everybody else, but it was important enough to me. And so it's exactly what you said, Semil. I constructed sort of a portfolio, and I said, how do I want to think about my own capital allocation? And I see the world sort of at two ends of the spectrum. And it's a barbell. And so in my mind, the way the barbell works is, I'm willing to write $5 million checks, $10 million checks at the early stage. And I'm willing to write, call it 20 to 30 of those maximum a year. And then on the other side, I'm willing to write one or two checks of $1 to $2 billion a year. And that's how I want to manage risk. And so in this bucket, what I really want to find are companies that have that 10x to 100x potential, but through a traditional IPO, they won't be able to tell the story. They won't necessarily be able to raise the amount of money that they need to do that. And as a result, they may be hamstrung, and so they may not know what to do. They may stay private longer. That has all kinds of deleterious consequences to them and to their employees. And so I focus on those outcomes where I can go and say, okay, you can only raise 100 or 200 million in an IPO. I can put $1 billion on the cap table. I can give you a price that you think is fair. I can make sure that you have a diversified ownership base. So now instead of answering to 3 or 4 people on your board, you have 50 or 60 people that are large holders of the stock. That's actually turns out to be way better, because the odds that, out of 3 board members, one of them is a fucking moron is high. But the odds that you have to listen to any one of 50 large institutional investors is actually pretty low. And so you actually, as an entrepreneur, again, not intuitive, it's counterintuitive, you get more control. But all VCs spend all this time pumping up like board control, small boards, but that's because they just want to be able to whisper in your ear. But the minute that one of them becomes dysfunctional or they turn out to be fucking stupid, which many of them turn out to be, you're screwed as an entrepreneur, right? So, I'm thinking about 10 areas that I think are structurally set up for 10x to 100x upside over the next 20 years. E-commerce and consumption online. These are not hoity-toity, but they're plain English, but they're pretty obvious. E-commerce and consumption online. Sort of deep tech, hard tech problems, healthcare, IT, and digital therapeutics, sustainability, climate change, decarbonization, fintech, AI and machine learning, enterprise SaaS, consumer network effects and subscriptions, education, and biotech. And in all of these 10 categories, I think the best way to be reductive about them is that they've all had certain underlying things happen in each of their categories that will allow a broad, diverse platformization and ecosystem development. So what's an example of this? Many ways, Semil, you and I, our success over the last 20 years really started in 2015 because of AWS, and then was accelerated in 2005, and then accelerated in 2008, 9, and 10 because of iOS and Android. That explains the overwhelming majority of our success because we were early enough to be around, basically. And so I think in many of these categories, the same structural platformization capabilities are actually happening now. So if you look at e-commerce and consumption online, whether it's payments, whether it's credit, whether it's long tail, last mile distribution and fulfillment infrastructure, it's all getting built now where the monopoly of Amazon is getting slowly opened up, right? And what's happening is the unbundling of Amazon across many dimensions. So that's going to be a huge category, right? Amazon's still going to be a huge winner, but it's a huge category. Sustainability, climate change, and decarbonization. You have a bunch of things that are inflecting upwards. Most importantly, the cost of PV and the cost of solar, the cost of wind is now materially at the same price or lower than wind and other fossil fuels. So that platformization is now happening, right? It's going to weave its way.
Can we talk about that for a minute? Like, how do you, because the way you're sounding it, it almost sounds like how a thematic VC would make an early stage investment. You're just applying it with a longer view and more capital in the slightly later stage. Can you walk us through just like the anatomy of like a Clover or Open Door or version of how you get to a point of conviction around something? Because I just saw the Open Door one and the arguments he made about it on CNBC like a few months ago. And I was like, wow, in a minute, you just kind of nailed these 5 trends, like reduction of salt, people moving around, pandemic. How do you...
to be honest with you, that's like 4 or 5 months of work. And
yeah. So that's what I want to get into. Like how, what is your process? Like, to the extent you can share, I don't want you to share secrets, but like,
no.
How do you wake up one day and go, yeah, Open Door is the one?
It's really not that. It's not like that. So I have these areas, just to complete the thought on the last one, like another area like biotech, the platformization there has been things like CAR-T, CRISPR. So my point is that in each of these 10 areas, I've kind of tried to write down the platformizing that's happening, right? That will allow startups to be built on top of it. And I think that there are, then there are things like COVID that have absolutely accelerated the adoption of some of these things and pull forward, 2 or 3 years of product development, product evaluation, the adoption cycle for consumers or businesses. So I kind of try to go and think about these things. And, I've said upfront that, we want to do an alphabet of these SPACs, right? So I always knew we had 26. The reality is I think it'll be much more. It'll be 100. It'll be 200 over, 10 or 20 years, right? So I think that this will be a business that we do for a long time. And so knowing that, what I'm trying to find in these, first few deals are ways to prove and continue to refine the product market fit of the SPAC as it underwrites one of these core theses. So, the product market fit of a SPAC is really about speed, it's about certainty, and it's about sponsorship. So just to unpack those for a second. Speed means you get a deal done in 90 days to 100 days, depending on, the SEC, depending on if you have to file CFIUS or not. But typically, HSR gets complicated, but normally call it 90 to 100 days. So once, when Eric Wu and I basically shook hands, you know, we announced the deal kind of 6 weeks later, and now it's working its way through the SEC. With Virgin, we announced the deal in July and we were closed in October, right? So that's speed. And that compares to about 9 to 18 months for a traditional IPO. Certainty means that we sit there, we negotiate the pre and the post. And so it feels like any other kind of round. You know what your cost of capital is because you know how much dilution you're taking, and you're either comfortable with it or not, right? And you get the brand attributes of that new investor, i.e. me and my partners, or not, and you either want that or you don't. But then sponsorship is this real feature that exists with us that is very unique, which is, I think that we have very good public market credibility because we've had some really good public calls. We've made a lot of money in the public markets, but we've also made a lot of money in the private markets. And we have a level of operational expertise. And I think that that allows us to bridge the translation between a founder and a lot of buy-side hedge funds and mutual funds. So that's the kind of value prop, right? So we're always making sure that whenever we see companies, do they need speed and certainty? Do they really, will they benefit from that sponsorship that we can give them? And then it's about going back to those 10 boxes and saying, okay, which ones do we want to do first? So as I said, our first one was a deep tech, hard tech deal. And it was in many ways the hardest to do because it needed all of these things. There's a lot of complexity because of CFIUS. It needed certainty and it needed sponsorship, right? With Open Door, what was really interesting about it was that what we were able to do was really help them translate what is a real estate story into an online consumption story. In the case of Clover, what we were able to do was show that this was technology enabling the reduction of costs and increasing outcomes so that instead of thinking about this backwards as a healthcare company, they thought about it going this way as a tech company that's attacking and disrupting healthcare. Now, why is that important for both of Open Door and Clover? Well, to the extent that these are ultimately successful businesses, it will result in a much cheaper cost of capital. And that ultimately, when you're a public business, has tremendous value. How much you borrow at, how much you can raise, how much you can use that to fund long-term growth. And in both of these companies, we're putting close to $1 billion in each of them. So so I guess, when you look at them, we've kind of done 3 of the 10. Obviously we have 3 more. My goal would be to find a unique one in 3 more of the 10. And then the next suite, we'll try to do that. So, and over the course of 10 years, what I would like to have is, 5 to 10 in each of these buckets. That'll be 50 to 100 companies.
Couple of tactical questions around putting the SPACs together, and I'm sure this will trigger more questions too. You had mentioned on one of the CNBC interviews that it may look easy on TV just to do one of these SPACs, but actually the operational knowledge and the public market track record that you bring matters a lot. So that'd be one question, if you can unpack that. And then related to that is, how do you or anyone running one of these things make sure that they're not being adversely selected, where there were rumors that people were trying to go after Airbnb via SPAC versus Airbnb wanting to go and sort of hold their own. How do you think about that as a manager of these?
First of all, I think that if a CEO is belaboring the decision between a SPAC and something else, I'm not sure. I'd be kind of curious as to why. I don't think it's really a legitimate question, to be honest with you. Why you'd want to take more time and only talk about the past, in my opinion, is the adverse selection. So, I think there are a lot of red flags in Airbnb's business. I think the biggest one is that they're going to run into this buzzsaw called Booking.com. They're going to be valued on room nights and they haven't proven enough to shift the narrative away from room nights. And unfortunately, that's Airbnb's future. So it actually benefits Airbnb to talk more about the past, where they had less competition. So I can understand why Airbnb is taking a different path than a SPAC, because people will sort of immediately focus on, tell me about the future and how what does your TAC look like? What does your LTV to CAC look like relative to booking, and what does room nights look like? That's a shitty conversation, because now all of a sudden you've been commoditized. So I think Airbnb is a unique case. So I think they're better off using a traditional IPO and hoping nobody, them not talking about the future is actually better for them, because I think the future is less bright than the past. For everybody else, I think the opposite is typically true if you're a normal tech company. When you execute these things, there's a lot of complexity. On the one hand, your customer is the CEO and founder and board. You have to make sure that you're explaining your outside-in diligence and view of the company to them. You need to explain your valuation to them. But to be honest with you, Semil, your real customer is the buy side. So what is the buy side? Those are all the hedge funds and family offices and mutual funds that will own your stock when you go public. And those guys don't want you to be spouting off on mission and vision. They don't want to hear Chamath blathering on about that stuff. They want to get to the nuts and bolts of Chamath. Show me your diligence. How did you underwrite this? And that's a very, very important process. And then on the heels of that, what they'll ask you is, how much of your own money are you putting into this? Because otherwise I don't want you to be upselling me, something where you don't have any skin in the game. And that's why I'm also very careful to always do deals where I'm putting a minimum of 100, to $170 million in each of these deals now. We put, I think, $453 million to work in the first 3 deals of our own capital, meaning not LP capital, like out of my paycheck kind of, writing the wire. And why that's important is not to brag. It's just that I got a lot vested in making sure that this is right at the same price that they're buying. And so there's a lot more credibility than when I say, believe my model, because I believe it. Right. And now when we, if it's wrong and we lose money, guess who loses money the most? I lose the most money, because I'm always the largest investor in these pipes and these things.
Actually, I feel like you're looking at my notes. I was going to ask you to walk us through the pipe and then opportunities within the pipe process that you see. I'm hearing now that people are doing SPVs into part of the pipe. So just love to zoom out and sort of learn from you what you're seeing there.
So look, the phases of a SPAC are, number one, we'll use round numbers as an example, right? You would go and raise a SPAC. The way that you do that is you go to a bank, you write an S1 actually, and you're taking a shell company public. Let's say you'd want to raise $200 million. And let's just say that you have the credibility to get that public. So now you have a $200 million public shell vehicle. You go around and you look for a deal, and let's say you find one. And let's say, the pre-money is 600 million and they want to raise 400. So you put 200 million from the SPAC. Now you need to find another 200. And typically how you do that is via what's called a pipe. And a pipe is a private investment in a public enterprise. And so what that is a process where you, the SPAC sponsor, and the company CEO, over a course of a week, conduct 30, 40, 50 1-hour meetings. It's very exhausting. It's very, challenging. But, you're forced to really articulate the story of your business in an hour and engage with all kinds of different kinds of investors. Some may be, fundamental long only shops. Some may be sector specialists. Some may be tech funds. Some may be art shops. But you're going to talk to the panoply of these folks, and you have to try to convince all of them to fill in that next 200 million. That's what a pipe is. And if you get it, then a few days thereafter, you announce the deal. You say, hey, I'm Semil. I have a $200 million SPAC. I have all these people committing another 200 million on the pipe. We're buying this company at 600 pre, 1 billion post, right? Now the pipe is really important because it allows you to market the company to a very broad base of shareholders, people who may not own the SPAC. And the reason they may not own the SPAC is that they may have, limitations. So, for example, a bunch of these mutual funds, the big ones, can't own a SPAC directly, but they can invest in the pipe. So I'm just making this up, but Fidelity may say, Semil, I love you. As soon as you find a company, come and tell me I can't invest in the SPAC, but I'll invest in the pipe. Right? So a pipe is a way to sweep in a lot of folks that are really high quality people that want to be associated with you and or the company, but can't. And so you pull all those people in. It's also a great practice because it allows the CEO and the team to learn how to manage and talk to the buy side. And that's going to be really important because after this process concludes itself, they're the ones running the quarterly earnings meetings, and they're going to have to show up every quarter and really know how to talk about the business.
Yep.
So that's how a SPAC works. That's how a pipe works. And that's why, I'm a big fan. I've done a pipe in every single one of our deals. And I think it's a very good feature.
Yeah. It seems like you're building in a much larger way, syndicate around the deal, right?
Exactly. It's a coalition of the willing, right? And
right.
You're also proselytizing, right? Because you have to remember, like when people understand your company and they get excited about it, they will then promote it to their friends and say, hey, here's my diligence on, pick your company. And here's why I love it. And here's why I bought it. Maybe you should buy it too. That's also why I publish one-pagers on Twitter. My open door one-pager was read 650,000 times by 650,000 people. My Clover one-pager was read by 550,000 people. I think why that's important is if you connect the dots on this, it allows a broad base of people to have a digestible way of understanding being a part of it. With Virgin, we are now one of the most widely held stocks in America. Again, this is a company that is, yet to start really generating revenue. So it's really incredible. So the SPAC process can be very empowering for companies.
So if we shift a little bit now in the second half, Chamath, to the audience here where you're mostly going to have VCs at small and large firms and small and large endowments and foundations. Let's start with the VC side. Do you expect, there have been a trickle of people that have followed you on the VC side. I think Lux Capital, First Mark, a few others that I can't remember, have announced that they've raised SPACs. Should they be doing more of these SPACs? Should they be turning it up and following your lead?
I don't know. What I would tell you is that I will never SPAC a company in my own portfolio. And the reason is because I have bought stock in the pennies, and I think that I would lose credibility and it would risk my reputation to bring a deal to somebody where I own 10, 15% of a company at 50 cents. And all of a sudden I'm like, I want you to buy this at 10 bucks. I just think it's not credible. I also think it's problematic because let's just say then I wanted to SPAC my own company. But again, these boards have 5 or 6 people. And one of the VCs is like, why you? And then they may also have a SPAC. Now, how does the CEO choose? It's all a shit show. So I think what will happen very quickly is boards will realize, oh shit, we're not going to do this mess. And so to the extent you have a SPAC, you're going to have to find a company that's not in your own portfolio. Then it comes down to reputation. So let's just say that, I'm competing with First Mark, on a jump ball for a company. I mean, I'm pretty sure I'm going to win 80% of the time. May not be true for 20% because somebody says, Chamath's a dick, fuck him. Okay. Except, I've done 3, and not really have I done 3. I've actually done 6, but 3 of them, we aborted the process because we didn't like it. So we've seen this 6 times over. We have documents for every kind of thing possible. We've navigated CFIUS. We've done everything. And I put a huge amount of my own money behind every deal. So you can choose path A, which is known, or you can choose path B. So, by the time you strip out the conflict of interest for doing your own companies, again, it's just going to come down to brand. And it's like me, Adam Bain, Dick Costello, Nirav Tolia, Jay Parikh, Ian Osborne. These are my partners, versus a fund. And then we have a balance sheet of billions of dollars where we can put behind the deals when we do it versus a fund. Then there's CNBC that basically is there to help me tell the story versus that fund. I mean, so it's just really, I think it's hard for them. I think they should try, but I think they're going to fail.
How should LPs be thinking about it? Let's say the LPs, part of their book is in private equity and venture capital, but also they're managing such large pools of capital. How can they be creative about getting involved in this, whether it's part of a pipe or doing something else, or getting to that liquidity sooner?
I think it's a little hard. Like, I mean, I don't have a good answer because on the pipe side, again, LPs are not, the traditional endowment or, fund of funds or whomever is not the person you want to have owning a public stock. And in a lot of cases, these folks, their mandates are as forced sellers, right? Because if they're your LP, they're taking long durational risk. It's unfair after they've held an illiquid instrument for 7, 8, 9, 10, 11, 12 years to say, hey, I want you to underwrite this for another 3, 4, or 5 years. At a minimum, it's a different pocket of their balance sheet. And it's probably different people that are comped differently, that have very different risk profiles, et cetera. At a maximum, if it's the same person, they probably don't want the durational risk. And so this is why you want to diversify. And so you have, a different kind of cap table construction when you're public, right? Otherwise, if you have 50% of the cap table in the hands of, 10 or 20 LPs and you distribute that, they're all forced day one sellers, it's going to be chaos. Now, I think LPs could, for example, find a way to go to the banks and say, listen, I want SPAC allocations. And, I think what a lot of very sophisticated investors do is they realize that SPACs are actually a great cash proxy. The reason is, like, when you come into a SPAC in the first place, the best feature of a SPAC is there's a back-end vote, which means that if you own a share of the SPAC and you don't like the deal, you can say no thanks and you get your $10 back, what you initially put up, because each of these shares are priced at $10 a share. And so it's a great cash hedge, right? Because you get cash if you don't like it, but you have this option of, oh my God, Virgin. Yeah, great. I'll do Virgin, And so, but the way to get access to that is basically to approach, the SPAC sponsors or to approach the banks and say, can I get into these syndicates? That's becoming harder and harder. So, in DENF, IPO's DENF that I just did, I gave a non-trivial slug to a bunch of very well-known CEOs, founders, very, very well-known founders, kind of sort of like top 30, 40 guys. And, between them and myself, I think we would eat up more and more and more. And so, I think it's hard for LPs to play unless they build goodwill. But if they can, that's how they should think about it.
On the flip side of this, what are some red flags you see? Because when people start these SPACs, I mean, I'm guessing one is around lack of potential operational experience. But for the audience out here, when they see, certain names they recognize on the SPAC or, people trying these things out, how do you start to sift out the ones that you're like, hey, that could actually be a real group versus noise?
I think that there are, if it was me as an investor, I think there are two ways to really think about the quality of the SPAC sponsor. One would be, do they have deep operational expertise, so much so that it overcomes their, lack of public market experience, or, it's an adjunct. The public market experience becomes an adjunct. The best example of that, I think, is, Reid Hoffman and Mark Pincus. These guys have built multi-billion-dollar companies. They've invested in multi-billion-dollar companies. They've seen every operational, upside and downside over 20 years of being in the Valley. They have deep operational credibility, I think. So, that's a good, I think, toolkit to operate from. Another dimension would be slightly different, or not slightly different, but orthogonal to that, which is exceptional public market investors. So, that would be like Brad Gerstner at Altimeter. And so, he just has an incredible insight into the markets. He's doing more and more, growth private investing, but, he is above everything else, just an exceptionally talented public market investor. So, Reid versus Brad Gerstner are clearly very different solutions that you're picking, but you get incredible capability. I think we're a little bit of a hybrid. We're a bit of a tweener because we've done both, and I think we straddle the line. I think we're probably the only one that does that. I think folks that are just like
Sorry.
early stage specialists, I think is problematic because it's not the pitch. Because you're going to walk into a buzzsaw when those people go and try to land a pipe into 65 fucking buy side firms, and you've never made money in the public markets. You've never written a deal memo that they understand. You don't understand how do they think about pricing and entry point and risk management and vol and turns of leverage. You don't understand how to de-SPAC it. You don't understand how to, you're going to run into a buzzsaw.
Yeah, they're years behind. One question from the audience here, and it goes back a little bit to the portfolio you're trying to build. How does a Chamath as in sort of like a social capital partnership 7-8 years ago think about sourcing as a VC versus now, social capital sourcing for a potential SPAC target? How does the sourcing change?
Well, back then there was this explicit strategy that I had to take, which was how do you break through the noise of the, entrenched orthodoxy in Silicon Valley? And, what I realized was my path to building a brand was being extremely candid and authentic. And, that's hurt me in certain places. I think at some points it also created a weird cult of personality inside my organization that was not well managed by me. It also amplified my insecurities deeply. That also created, all kinds of organizational, Sturm und Drang, which I could have avoided. But that was the only path that I saw early on to deal flow. Stand out, market my Facebook experience, but be kind of a loudmouth. Just to kind of, because, and then you get noticed and then you win on your operational credibility. But you first had to get noticed. I was a VP at Facebook. It's not as if anybody knew who the hell I was. Kind of they did, but not really. Now it's different. I think, like the great American tragedy is always sort of written in these 3 chapters, the rise, the fall, and the rebirth. And people like a comeback story in America. And they like it at scale even more. And so, I think that now just to see that we've landed on our feet, that the returns have actually gotten better, that these 3 deals already have done so well, that we're kind of pushing the envelope, meaning, we were really the one that popularized the SPAC. We landed an incredible first one. These next 2 are brilliant companies, in my opinion. Then we're the only people ever that did 3 IPOs in the same day in the history of the NYSE. So all these firsts, I think, lend itself now where if you're if you're a unicorn, I don't think you're thinking, wow, I really want to be the guinea pig here for XYZ person who's never done it before. At a minimum, they're going to give us a call and say, okay, pitch us why you. And, our pitch is just more like, look, we put our own money behind every deal, hundreds of millions of dollars. We do incredibly detailed diligence. It takes months to boil it down to a 4-minute pitch on CNBC or to a, 1-pager. This, I know it sounds so stupid, but it's not. Like, this shit's really fucking hard. And it's pressure filled. Like, you get in front of that fucking camera, most people are going to wilt, they're not going to know what to do. So it's hard. And, be able to take the slings and arrows, and it shit's hard. It tests your mental fortitude for sure. And I think we're good at it.
Can you share just on that point, like, for you, it seems like you're so effortless in explaining these things. And I know you go through your own process that we don't see, but like, what is something that we don't see that's really, really hard, even just to speaking on CNBC that you mentioned?
If you look at if you look at the process on Open Door, the reason I remember this is because we took pictures and documented the whole thing. I remember we started in sort of August. And, we were all at my house. We were socially distanced outside. Then we came inside and we're doing these pitches over and over and over again. And I remember, it wasn't in August because I was still in, I was actually still in Europe at the time. And I remember dialing into these meetings and going it over and over and over and over again, tens of times, and then meeting in person and editing every last little detail of the deck and completely ripping it apart and starting all over, and then writing our own deck that summarizes our own diligence, and then helping Eric restructure his, and then practicing this elegant handoff between me and him and Carrie Wheeler, the CFO. Then writing these one pagers, getting it all cleared by legal, then doing 65 pitches, an hour to an hour and a half at a time over the course of a week. It is a brutalizing process. But at the end of that, you can get on CNBC and you can really dial it in for 4 minutes. It's like anything else, which is that when things look effortless, I think the smart, rational person should say, this guy's probably not fucking lucky. He's probably a grinder, no smarter or dumber than me. So he must have put in a ton of hours there. And the answer is we did, And, I remember for Virgin, Adam Bain grinding until 4 a.m. in the morning, calling around the day before we were going to file and announce the deal on CNBC. Adam stayed up all night. He barely got all the signatures in place. All the final terms went down to the 11th hour, scrambling to try to get CFIUS because we had this all of a sudden. Like, it was nuts. Nobody sees that. All they see is, oh, Virgin Galactic, there's fireworks, there's Richard Branson, he's in a spacesuit. Wow, it's fantastic. It's nothing like that. Like what I'll tell you is you can see it on my face, because if you see Virgin, I was like, it's like professionally shot. So like, I looked like healthy and fresh. Open Door a little less so. By fucking Clover, if you look at me on CNBC, I looked like I was run over by a Mack truck. I was so goddamn exhausted. I mean, it's mentally exhausting. You're pushing your mind.
One question, and then I'm gonna pivot real quick as we end up. But a question from the audience is: you mentioned you had started and stopped on a couple of these SPACs. What happens with the company then? Is it sort of just like a, hey, let's take a break, or does that information become public in private markets, or?
It does not. I'm not in the business of sharing that information. I don't see what the point is. A lot of our diligence is very unique. I think that's one of our superpowers, is that, we're deploying engineers and data scientists into a company to do diligence. We don't we don't deploy accountants. In two of these companies, our diligence pack that we run through with the CEO or the owner of the business, depending on, the configuration of the cap table, is like, 20, 30, 40 pages of work that they've typically never, ever seen before. I don't care how sophisticated you are. This is the same level of work that my team and I did at Facebook. And we've refined now over a decade. So it's a really good tool chain of stuff that we do. It's not what other people do. In two of the three cases, Semil, our team continues to stay involved with them, and we're working with them every week. We love the companies. We love the founders. We love the owner. We're just really committed to them getting to the finish line. And so we just kind of stay with them, and we hope, and we don't have any expectations, if it turns out that they, ultimately A, are ready, and then B, want to work with us, we're super excited to do that and be their partner. Maybe they choose not to. We're fine with that as well. In one of the cases, it was just basically a situation where we didn't like what we saw in diligence. We felt like it was not completely, this was for IPOA, where, we just felt like it was a little too misdirected from how we were pitched it and what we saw to then what we found. And we didn't want to make a big deal of that. We just kind of said, this is not a great fit for us, and we walked away.
And how does a de-SPACing work at a point of an exit? Or is that sort of a bridge across much later?
That's the bridge to cross much later. What I'm talking about is when you've issued an LOI, you're deep in diligence, and when you're trying to get the merger agreement done, you realize this is not going to work. You put a pin in it. In the case of a de-SPAC, that's, if you just do a really bad deal and people hate it, then definitely they could vote it down. It hasn't happened in the entire market recently. And I think the reality for that, quite honestly, is less about company quality, but more about rates. as rates have gone to zero, even buying a 10 or 20% a year growing company, which is essentially buying GDP plus 500 or 600 basis points, is better than nothing. And so, the tendency will be for all these SPACs to de-SPAC successfully, unless the price is so egregiously offside. But even then, you would just get that signal up front and you would change the price.
So as we wrap up here, I saw your tweet about the Ant Financial IPO.
I think that China is uninvestable. I've always felt that way. I've always thought it's a wild, wild west. I know that a lot of people have made a lot of money. This thing proves to me that it's basically non-scalable and it's not reliable. Jack Ma gave a speech, and based on the contents of the speech, now it was monumentally fucking dumb, but based on the contents of that speech, you just shelved a $35 billion IPO. It's unbelievable. And more importantly, Semil, today, they have introduced laws that are going to make it harder for Ant Financial to be a viable company. That is incredibly arbitrary.
And what signal do you believe they're sending in that sort of action?
You live under our purview, and it is because of our largesse that you are allowed to thrive. And what that basically is a different way of saying is every company is state controlled and state sponsored at some level. And that's really no different than Russia. And so if you're willing to pay the tax and pay the vig, you will be allowed to exist. And if you're not, be very careful. And I think that is an incredibly scary message. Will people make money in China? Absolutely. But I think you have to be just slightly dumb enough to be more greedy than smart. And so you say, you know what, there's a risk, but fuck it, I'm just going to go. I can't do it. I just don't have the courage. It proves to me that I know nothing about an entire continent of 1.2 billion people. I don't speak the language. I don't look like them. And it's a very hard, unpredictable, insular market. And I think that that's great. It's great for the Chinese. I'll do other deals. There's more deals in the rest of the world.
As you think about, as an investor, maybe the final question, moving into like a Biden and sort of split Congress situation, how do you view 2021 unfolding with that kind of setup?
Markets way up. I think that I think you still have another 10 to 20% in the S&P without much thinking. It'll be interesting to see if there's going to be another stimulus bill. I think there's a lot of stimulus dollars that are sloshing around that could spark a little bit of inflation. If you look at 10 years up and up, they've rallied 15, 20 bips, which tells you that some people, smart money, is thinking that there's a little inflation around the corner. But quite honestly, I think markets are up. I think the reality is with a Republican Senate and a Democratic presidency, historically, that combination has yielded the most fiscal discipline. And so if you think about that, the markets have to re-rate 10 or 20% because corporate taxes will stay where they are, right? So just on an earnings lift, you can take the markets up 10 to 20%. Just on that basis, the difference between Biden's proposed tax plan, which is not going to happen at the corporate level, and where they are under Trump. So that gap takes you 10, 15, 20%, depends on the company. That's number one. And then number two, I don't think you're going to see a massive stimulus package now of dollars flooding in from the Fed. But that being said, there's still an enormous amount of money. There's still $600 billion of PPP that's still like kind of sloshing around unallocated. There's still a huge balance sheet that the Fed can spend. So we're going to see markets go up. And then the third thing is for big tech, I think it's all bad. I mean, this is the worst outcome. This is the worst outcome. Like Trump, Biden, that would have been better than Biden Republicans, because now they are going to try to get one piece of legislation passed to prove that they're not complete dipshits and go into a re-election cycle for 2022. What do you think that is? It's going to be some kind of antitrust legislation, or it's going to be a Section 230 repeal. That's what smart money would tell you. It's not going to be a stimulus bill. It's not going to be a tax bill. It's not going to be a healthcare bill. It's not going to be amnesty on taxes. It's not going to be immigration reform. What is left? There's one common enemy. China, Russia, doesn't matter. It's domestic. It's big tech.
Wow, awesome. Chamath, thank you so much for doing this. And sort of giving us your time and sharing all these insights. Thank you so much.
All the best to you. Congrats on all the success.
Okay. You too. Thank you. Bye.
Thanks, man. Bye.